All right, welcome back. Today we're diving into a really big question for anyone who's doing business or working between India and Malaysia. And that question is, how do you deal with taxes without getting hit twice?
I mean, think about it. Are you earning money in one country while you're technically a resident of the other? It happens all the time, right? But it comes with this massive headache. You could end up paying tax on the exact same income in both places.
But don't worry, there's actually a powerful agreement designed specifically to solve this exact problem. So let's break down how it all works.
So here's the problem in a nutshell. When your income crosses a border, the tax authorities in both countries might want a piece of the pie. And without a clear rulebook, you could easily end up paying taxes on your hard-earned money in India and in Malaysia. Ouch. Luckily, there is a solution. It's an official treaty, and it's called the Double Taxation Avoidance Agreement, or as we'll call it, the DTAA. You know, this isn't just about saving you money on taxes. The DTAA is a full-blown legal agreement between India and Malaysia, and it really has two main goals. First, obviously, is to make sure your income isn't taxed twice. But the second goal is to actually encourage more trade and investment by making the tax situation predictable and clear. And this is not some new idea. This economic relationship has been growing for decades. The first agreement was way back in 1977. But the one that really matters for us today is the updated comprehensive agreement that was signed in 2012 and went into effect in 2013. That's our rulebook.
So, how does this treaty actually save you money? Well, it all comes down to a few key rules, and you really have to understand them to get the benefits. Let's start with how it all works for businesses.
Okay, the first big concept you need to wrap your head around is something called permanent establishment, or PE. The best way to think about it is as a tripwire for business taxes. If your company's activities in the other country are significant enough to trigger this tripwire, then you suddenly become liable for corporate tax over there. So when exactly is that tripwire triggered? Well, the India-Malaysia Treaty is super specific about this. It could be something obvious, like having a fixed office or a factory. It could be a construction project that goes on for more than 9 months, or even just providing services for more than 90 days in a year. You can even trigger it by having an agent there who's signing contracts for you. Now, that was for businesses. For individuals, employees on assignment, there's a whole different magic number you need to burn into your memory: 183. This 183-day rule is absolutely crucial. Here's the deal. If you're an employee working abroad for less than 183 days in a 12-month period, you're generally taxed only in your home country. Now, there is a catch. Your salary can't be paid by a local company in the country you're visiting. But if you cross that 183-day line, things flip, and your income becomes taxable in the country where you're actually doing the work. Now, one of the biggest, most tangible benefits of the DTAA is for investors. Just look at this. Without the treaty, the withholding tax on dividends could be 20%, maybe even higher. But with the DTAA, it slashes that rate all the way down to just 5%. That is a massive, massive saving. And hey, this isn't just about dividends. The treaty brings that same kind of clarity and savings to other things too. It caps the tax rates for interest, royalties, and fees for technical services at a predictable 10%. That certainty makes doing business across borders way more attractive. Okay, so knowing the rules is one thing. Seeing the potential savings is great. But how do you actually claim these benefits? Well, it's not automatic. It involves a few mandatory steps you have to take. All right, here's your compliance checklist. Step 1, you have to get a tax residency certificate, or TRC. That's the official proof from your home tax authority saying, yep, this person is our taxpayer. Step 2, if you're a non-resident earning in India, you have to file a self-declaration called Form 10F. And Step 3, if you're an Indian resident, you use Form 67 to get credit for any taxes you've already paid in Malaysia. And trust me, these are totally non-negotiable. And let me be really clear about this. This isn't just optional paperwork. If you fail to comply, if you don't get your TRC or you forget to file the right forms, your treaty benefits can be flat out denied. And that pushes you right back into that higher tax bracket. But here's the thing. In the modern world of international tax, the game has changed. It's not just about paperwork anymore. There's a whole new layer of scrutiny that you absolutely need to be aware of. It's really summed up by this idea: it's no longer enough to just follow the rules. Now you have to be able to prove why you set up your business or your transaction in a certain way. And this really gets to the heart of a major shift in how tax authorities think globally. So, in the past, authorities mainly cared about technical compliance. Did you have the right documents? Did you check all the boxes? But now, the question is so much deeper. They're asking, why did you do this? Was the main reason for your business structure just to get a tax break? This new hurdle is officially called the Principal Purpose Test, or PPT. And honestly, the best way to think of it is as a smell test for tax authorities. If they look at your transaction and conclude that one of the main reasons you did it was just to get a treaty benefit, they have the power to deny you that benefit, even if you followed all the technical rules perfectly. Phew, okay, we have covered a lot of ground. So let's pull all of this together and consolidate it into a clear, simple action plan. All right, here are the key takeaways you need to remember. First, there's a powerful DTAA between India and Malaysia. Second, it offers huge benefits, like slashing that dividend tax down to 5%. Third, if you're an employee, that 183-day rule is your North Star. Fourth, compliance is absolutely mandatory. Get your TRC, file your forms. And finally, remember the new rule of the game. Your business structure must have a real commercial purpose to pass that principal purpose test.
And that brings us to our final question, and it's really the one you should be asking yourself if you operate between these two countries. Is your cross-border structure built for real commercial substance, or is it just built for savings?